Hello, classmates. Hello, instructors. My name is Camila Manley, and my research is about mortgage financing. And first, we're going to start with a general concept. A mortgage is a loan in which property or real estate is used as a collateral. This means that the loan will be secured by the property. The borrower enters into an agreement with the lender, which is usually a bank, and the borrower receives cash upfront and then makes payments over a set of time until he or she pays back the lender in full. One must make monthly payments on a mortgage, the loan principal plus interest, and there is a set term before full payment is due, often 15, 20, or 30 years. If one defaults on a mortgage, the bank making it may take possession of the real estate and sell it to receive its investment. When the loan is repaid in full, the property is yours. Now we are going to learn about the types of loans. We have the fixed rate mortgage, in which the interest rate will remain the same for the entire life of your loan. And then we have the adjustable rate mortgage, ARM, in which the interest may adjust at regular intervals and may be tied to an index. When the interest rate on an ARM adjusts, it may cause your payment to increase. Some of these ARMs allow the borrower to pay the interest only or less than the interest only. In both options, none of the mortgage payment is applied towards the principal. In less than the interest-only option, the unpaid interest is added to your loan balance and you can owe more than the amount you initially borrowed, even if you make all your payments on time. This is called negative amortization. If you are a first-time borrower and your mortgage could result in negative amortization, your lender is required to make sure you get home ownership counseling before you borrow the money. When the loan balance increases to the maximum amount, the loan is recast and your loan payment may double or even triple. When faced with payment shock, you may discover too late that the loan payments no longer fit within your budget and that the loan is difficult to refinance. You may then be in danger of losing your home. There are some government programs that you may be eligible. It is Federal Housing Administration, Department of Veteran Affairs, Rural Housing Services. These programs usually require a smaller down payment, but you have to ask the brokers and you have to shop and compare quotes from different originators because each may offer different rates and loan terms. Then we have a conventional loans. This is a loan that is not guaranteed by any government entity. You can use it to buy a vacation home or an investment property, as well as a primary residence. When it is supported by Fannie Mae or Freddie Mac, you can get for a single family home, a loan limits are $424,100 in most of the country. And they have really improved a lot and they have become very competitive. That means that they can even get a 3% down payment option, which is lower than FHA for qualifiers. Other things to consider are that in addition to the principal and interest portion of your mortgage payment, you will have to pay property taxes and insurance to protect the property. Your lender may require an escrow or impound account to pay these items. But if an escrow account is not required, then the borrower is responsible for making these payments when it is due. Mortgage insurance may be required by your lender if your down payment is less than 20% of the purchase price. It protects the lender if you default on your loan. You may be able to cancel mortgage insurance in the future based on certain criteria, such as paying down your loan balance to a certain amount. It is designed to pay off a mortgage in the event of a borrower's death or disability. Then you have the homeowner's hazard insurance that protects the property in the event of a loss such as fire. Many lenders require that you get a homeowner's policy before settlement. Last, we have the flood insurance that will be required if the house is in a flood hazard area. After your loan is settled, if a change in flood insurance maps brings your home within a flood hazard area, your lender or servicer may require you to buy flood insurance at that time. Then I'm going to share with you some mortgage regulations that have been renewed after the mortgage crisis here in the United States. The Truth in Lending Act, TILA Regulation Z, it requires the disclosures of cost of credit, finance charge, APR, payments, and interest. This means that the borrower will know exactly how much money will be paid at the end of the loan or the mortgage. TILA RESPA, this rule sets forth the new disclosure requirements, loan estimate, and the closing disclosure. Real Estate Settlement Procedures Act, RESPA, or Regulation X, helps consumers become better shoppers for settlement services, eliminates kickbacks and referral fees. We have also Equal Credit Opportunity Act, or ECOA, or Regulation B. It prohibits credit discrimination based on sex, race, marital status, religion, age, national origin, or receipt of public assistance. Fair Credit Reporting Act, FCRA, or Regulation B. The purpose is to regulate credit agencies and ensure privacy of consumer credit reports. Gramm-Leach-Bliley Act protects privacy of consumer information. Home Mortgage Disclosure Act, HMDA, provides public with information about how financial institutions are matching credit needs. These regulations are designed to protect the consumer, but we also have many regulations that protect the lender as well. Thanks for watching.